Today is going to be an interesting show. Like I said at the top, but a lot of you couldn't hear me. We have the Fed announcement today at 1 o'clock Central, so it's 12:09 now. So we'll be able to go to that 1 hour-ish mark and be able to cover the Fed announcement to see what they're going to do. A lot of people are going to say that they're not doing anything. That's mostly what that's mostly what I've seen, is that they're saying nothing. That the Fed is just going to leave rates where they are, higher for longer, remain the same. However, and we'll get this in just a second, there have been some changes around the world in the Fed. So Olivier from Canada sent me what happened on the Canadian. But before we get into all that, I want to talk about this really interesting story about an MLS fighting back against the NAR settlement. Have you guys heard about this? Several of you sent me the reels. There were several creators that created reels kind of about this. But the article is on Broke Agent Media. It says NWMLS becomes the first MLS to say no thanks to NAR settlement terms. What? This is really interesting. So 2 major MLSs made big announcements this week. On Tuesday, they published a statement on their lack of interest in opting into the NAR settlement, becoming the first non-NAR MLS to go public with its intentions. Putting aside the cost of opting in, NWMLS provided 2 reasons for going their own way. A day later, California Regional MLS, CRMLS, launched a new set of MLS fields, Concession in Place, CIP, to improve communication between listing agents and buyer agents and home buyers. Now we'll get into that. I don't think that is what you guys think it is. So we'll get into exactly what goes in that blank and what the rules say can go in that blank. Both MLSs are prioritizing transparency in real estate listings, though only one is calling out the National Association of Realtors for settlement terms that eliminate transparency and increase the risk for consumers. Interesting. So there's 2 reasons NWMLS will not opt into NAR settlement. This is what they said. They already have in place listing standards that improve compensation transparency and has had those changes take place for several years. In place for several years. The NAR settlement eliminates compensation transparency for buyers and limits sellers' choice by banning offers of compensation from the MLSs that opt in to the agreement. Essentially, the NWMLS is saying they're already ahead of the game of improving compensation transparency and protecting the seller's rights to make offers of compensation as easily accessible to buyers' agents. There's nothing NAR is doing that NWMLS can't do on its own or is already doing. So this is interesting. By not opting in, Matt Lamar said he's just here for the comments. By not opting in, it's basically saying, it exposes themselves to risk of a lawsuit. But it also is saying, like, we're not a part of this. We're doing our own thing, and we believe that what we are doing is right, and they're willing to fight for it. Michael Ketchmark, who's the lead counsel in Sitzer Burnett, says time will tell how the new NWMLS rules benefit home sellers compared to the NAR settlement. But as a rule, I'm always suspicious when the fox says it's guarding the chicken house. And that's what's happening now in Washington. Now, opting into the settlement would cost them $3.31 million. That's an amount equal to 100 multiplied the number of NWMLS members in the calendar year of 2003. That's a lot. So they go in, Justin Hagg, the NWMLS president and CEO, goes on to basically say the same thing of what they're doing, why they're doing it. Matt Lamar said, I thought it was a hen house. Did taxes go up? Yeah, you really wouldn't keep all chickens. I mean, what good are roosters really? Let's see, the CMLS, so the California MLS, this new concession price field thing It says it's to provide upfront communication on concessions to improve communication transparency between listing agents and buyer agents and home buyers. So they said in the agreement that if you have a compensation blank, and I'm doing a terrible job of phrasing here, okay? But if you have a compensation blank in your MLS, it cannot be used for commission. So they basically can say, hey, here are the concessions that the seller is willing to provide, but it cannot be used to communicate compensation for buyer agents. So I don't know exactly how they will skirt around that, I guess you could say. And I don't know. We'll kind of have to wait and see how that's used. Okay, so what do you guys think? Clubhouse folks. NWMLS, the first MLS to say no thanks. Is this a good idea? Bad idea? How do you feel about it? In my opinion, I feel like more MLSs should do this if they haven't already. And I feel like they are more clearly articulating the need for transparency on the commission side than any one of the attorneys that would just say, well, they're 1099 employees. That's just not effective.
I absolutely agree with that.
You agree with which, Andy?
Northwest.
Northwest.
I think if we all, some of what they were saying, is basically what us as agents have kind of been thinking all along. And like, this is what we wanted NAR to fight for in the first place. And now a separate MLS is saying, hey, look, we're not a part of this because we feel that it's not conducive for buyer or seller. It doesn't matter. It's not conducive for the business as a whole. It's not conducive for transparency or anything like that. Everything that has been agreed upon is actually against transparency. And it's just absolutely insane. If a seller on their own decides, that's fully informed, decides that they want to pay a buyer side commission, then they absolutely have the right to do so.
Yeah.
But DOJ is saying, hey, we don't ever want that to happen. But why? It makes the property more marketable. If somebody really wants to sell a property fast and it puts them at the top of the market because they're willing to pay the buyer agent commission, then they should have the means to do so. They should be allowed to do so. I don't know why the DOJ is getting in the middle of it to that extent, that it just blows me away. And to say that, hey, we're just going to hide all of this information and it's going to help everybody. Hiding information doesn't help anybody. It's
right.
It's a lie of omission, right? We're not going to tell you what we're going to pay if we pay anything at all. And then you're going to come to us and expect to get paid or hope to get paid. But no, we're not going to do it. And we're going to negotiate back and forth without anything being said. No, that is a lie of omission. And there's so much worse that could be going on with that. I mean, I dealt with a lie of omission last week on a real estate situation. And, it kind of blew me away. And I was told to be, hey, don't take it personally. This is a relationship business and this is how things kind of work. You can't omit information and expect everybody to be on the same playing field. It's just not going to happen.
Yeah, I agree with your take on that too. It doesn't seem like increased transparency is happening because of the hiding of a commission that's being paid to buyer. What they're trying to say, the NAR settlement, is, hey, this increases transparency because we're requiring a buyer broker agreement between the buyer and the realtor. That way there's transparency on how they get paid and whether they get paid. That's a great idea. I think that's fine. We've been doing that since 2007 here. That's when I started real estate. I think it was before that even. So I think that's a fine idea and that's great. That does increase transparency, but it doesn't make sense for me to also decrease transparency by not showing what other people are offering. And it's weird that the idea, so I guess I have two thoughts on this. In one part, I can see where a great listing agent negotiating commissions will prop up weak buyers agents who aren't negotiating. However, if you say, well, I want to offer some commission, some compensation for a buyer agent to come show this property so that we get more activity. The opposite also has to be true. And it's weird that the industry doesn't want to admit it or wants to hide this as a thing. But that also means that if you don't offer compensation, buyer agents won't want to show it. And no one wants to say that because supposedly the fiduciary duty is supposed to be to the buyer, and you do what's best for the buyer to the detriment of yourself. But it's just not real life. I mean, I think everyone knows that if there's no compensation offered, it's going to be a difficult transaction. One, because now that fee is going to the buyer and they have to pay it, so it's going to lower their offering amount. But two, you're asking an agent to now work for free. And if their buyer's unwilling to pay them and the seller's unwilling to pay them. And so you have situations where buyers don't want to have that conversation, or buyer agents don't want to have that conversation with the buyers. And you can't have one without the other. You can't say, I want to add some compensation or a bonus or whatever to encourage agents to show this property, but somehow the opposite is not true, where if you don't offer compensation, no one's going to show it. Like, that doesn't make sense. You have to have both. And I believe that's just the way people are wired. If you go to a car lot, they have bonuses and stuff on certain cars, and they're going to try to push those cars for you, no matter your duty, no matter their duty to you as the buyer. They don't have any. They represent the seller. So it's interesting. I don't know. My brain always goes back and forth. Yes, I see the point. A great listing agent who's negotiating compensation is propping up weak buyers agents who can't validate their fee to their buyers, but it's also probably a lack of service to that agent from that agent as well. I understand that. However, I don't think it's necessarily going to make the seller save money in most cases. I think it's going to have what's the word I'm looking for? A desperate impact on the marketability of the property to most of the agents in the marketplace who do a good job of communicating their value, but their buyers don't have the money to come out of pocket to pay the buyer agent. So it's both ways, but I think the best solution is increased transparency. And I don't think you can look at all the MLSs and say, well, it's clearly collusion, when you have business models that are created around that whatever percentage, 2%, 2.5%, whatever it's offered in those marketplaces. There's entire business models and brokerages that operate based on that number, or based on averages of that number. There's also the opportunity for buyers to buy themselves. There's always been that opportunity. There's an opportunity for buyers to use a discount agent. That opportunity is more rampant than ever, I would say, and growing. So those are in the marketplace as well. We all know the agents that provide rebates. Those are in the marketplace. And for a lot of reasons, people choose not to use those agents and to use someone that's full service. And that's fine. Those options have always been in the marketplace. And because those options are provable, and you could see these companies that are trying to do that, like Opendoor, which we'll get to in a minute, they have an announcement of something they're doing in Nashville, then it makes sense to me to let the market decide and to put it out there and let the buyers and sellers see what that number is. That just makes sense to me. So I don't understand how hiding it is helpful in any of those scenarios, other than they're trying to somehow say, by hiding the number, that number will eventually go down. That doesn't make sense. So you could say I'm a little torn, but I'm always leaning towards more transparency and that number should be out there. But I do understand the argument. And I think, Andy, you explained it pretty well to me one day, where you're like, no, it does prop up. It does prop up weak buyer agents. All right. Any other words on Clubhouse before we go to the next story? Matt, I saw you on mute. I thought I saw you on mute.
No, I think it was me again. I was just going to point out, you're talking about, and you've mentioned this before, especially when this stuff first came out, about the VA buyer, the veteran buyer. Now, we've had some information come out that was floated out there, and everybody hopped on it, but there's nothing actually in writing yet for the VA to put out a circular that's going to temporarily change one of their laws. But we don't even know what it says yet. My understanding is that they don't even have anything on paper yet, which is wild to put something like that out publicly when they don't have anything written down yet. But we don't know what is that exactly how it's going to say, what mechanism they're going to use to get around that. So my thought process is that it's still going to put veteran buyers behind the eight ball. And I don't think that helps anybody. Not when the stat that I put out yesterday, 14% of the mortgage market share is VA home loans, while that's only 18% of eligible veterans are using the benefit in that 14%. So that's actually wild to me that they would even put them further behind. And that 14% has grown from 8% from a few years ago. So we've always struggled, and now that we're getting more information out there and the loan is actually being seen in a better light for most.
Yeah.
Now you're going to put them behind the eight ball again with some of this stuff. I don't think it's helpful for the whole marketplace, but also especially for veterans, which is my niche.
Yeah, I agree. One important follow-up question, Andy, is it niche or niche?
Well, I grew up in Georgia, so I say niche.
All right, good. Let's see. Oh, I can share a little bit. This is going to be a little mirroring action over on the YouTubes, but Pinbay Monet, what's up? She said, we just need more transparency around, but most of the member-owned MLSs are made up of small offices that are scared not to follow the herd mentality. I do think that is a big part of it. And yes, I heard about the Canadian rates. We'll get to that in just a second. CBC.detailing said, can you post a link to the Clubhouse room? I can't find it. So if you go to Clubhouse and you type real estate networking, it's one of the largest groups. The little emoji is like a handshake emoji for the symbol. It's one of the largest groups in Clubhouse of real estate agents. And we are live in that house. So if you know how to use that, then that's where to find it. Okay. You're welcome. Thanks for watching the show. All right. So it's not over yet though. So a lot of the settlement and stuff are like, hey guys, the settlement's done, right? We can all just kind of go about on a merry way. Wrong. Buyer appeals Keller Williams anywhere in RE/MAX settlements. So the franchises are not required to implement the business practice changes until after the appeals process. You might recall last week, 2 weeks ago, they were trying to stop the approval of the nationwide settlement and antitrust. And there was someone that launched, I can't remember what it was called now. There was some kind of appeal or whatever. Well, that buyer is now appealing to a higher court. The appeal may delay the implementation of the settlements in which Anywhere, RE/MAX, and Keller Williams agreed to pay $83.5 million, $55 million, and $70 million respectively. No one in the settlement class who has made a claim will receive a payment until the appeals have been resolved. So I'm wondering how many appeals they can go through. Like, can people just continue to appeal and continue to appeal for years and years and years? Or is this like a one and done type of appeal? And if they don't get it, then in a certain amount of time, it's over. If you're an attorney, let me know. Let's see. Ketchmark. Did Ketchmark say this? An appeal of this kind is neither unusual or unexpected. We have full confidence that our settlement is fair, reasonable, enforceable, and the trial court's order to grant final approval will absolutely be correct. That was the spokesperson for Anywhere. Settlements for the three claims cover the cases known in Sitzer Burnett, Morrill, and Nosalisk, as well as other similar home seller suits nationwide. Ketchmark says we have to evaluate it on a case-by-case basis, whether the other defendants can wait to implement the practice changes until after the appeal, but the failure to do so could expose them to additional liability. Any company with common sense should do it now. Oh no!
What is the prize that he would say that?
Yeah, I know, right? You must do it now. Olivier said he was busy getting a ticket for speeding. Oh no, Olivier, you can't speed in Canada. I drove some in Canada and I was afraid to speed. Everyone drives so slow. I mean, you guys follow the speed limit more than any other place I've ever traveled to. All right, that's beside the point. All right, so it's not quite over yet. We'll see how the buyer appeals. It's going to a higher court. We'll see what happens.
Hey, Ray, Jan put his hand up in Clubhouse when we let him in.
Oh, yeah. What's up, Jan?
has something to say.
How you doing, man?
Hi guys, I was just looking for the unmute button. Thanks for sharing your thoughts on what's happening in the real estate. So it looks like they pushed the implementation of this new rule to August, right?
Yeah, August 17th for the NAR group. That's that settlement.
That's right. That's right. But in our industry, like in our market, nothing has really changed. All the listings have the exact same things. It's like the buyer's agent's commission is pretty much like intact, as if nothing has happened. And we just got a notification that they are changing the spot. So where it shows right now, which is a percentage, it will be moved up, and then it will be a percentage or a number. So I think this whole emotion and big hoo-ha was just for changing the spot on the MLS from one spot to another, and allowing for it to be in a dollar amount. So it may just be that.
Yeah, I don't know exactly how it's going to play out. I see some people advertising, like new low fees because of the settlement, but they were already discount agents way before the settlement was in place. So I think the FCC is probably going to weigh in on some of the false advertising stuff around the settlement and around agents using it. It wouldn't surprise me at all if there's a couple of people that get in trouble for, advertising something that's not necessarily true. I'm already seeing now people say that, sell your home for half due to the settlement. And it's, once you get into the details, I would be a little worried about the bait and switch rules with is it FTC? Yeah, the FTC. I think they may weigh in on some of that as things shake out. But yeah, well, in here in Arkansas, nothing's changed at all. So we still have the blank in the MLS, and there's no difference at all. Olivier said $80 for 48 in a 30 kilometer per hour. Ladies and gentlemen, 38 kilometers per hour is like, what, 18 miles an hour? That is so slow. Like people run that fast. They do not drive on the opposite side of the road, Matt. They drive on the regular side of the road. Even though
the Mounties have to catch you by horse, don't they?
They do. I was asking my friend Brad McCallum, who's in Canada. I said, these Mounties, how do they pull you over if they're on a horse? And he said, oh, no. All the Canadians pull over for the Mounties because it would be so insulting to disrespect a Mountie like that. All right, let's keep it going. I want to talk about Opendoor. So they've got a new plan, and it's launching in Tennessee. I actually said this to my friend Marie Lee, moved me to Tennessee. It's Opendoor rolls out mobile truck with instant offers in Nashville. So they're literally going to bring the offer straight to your house. The company's new mobile truck, dubbed the Offermobile, is driving through Nashville, literally meeting homeowners where they are at to gather home and market details and provide them with an offer. So they're no longer, I guess they are taking online inquiries, but they're also just meeting you at your house. Isn't that what a realtor does? There's a video. It says selling a home is stressful and could take several months. So we made it fast and easy. Let me zoom in on the video just so you guys can see it here. All right, I hear some interference on the Clubhouse thing. All right, so it looks like for the audio listeners, it looks like a truck. I don't know if this is what the actual truck looks like, but it's got like a desk setup and a gigantic computer screen and coffee mug. And the ad is they're driving in front of houses, and the computer screen frames the house and tells you at the bottom left of that computer screen that is now framing the house that they're driving in front of, what the offer is. I think that was a pretty good description. And it says skip the hassles on the coffee mug, and it's their Offermobile. Of course, it doesn't work exactly like that. It's just, the marketing campaign that they put behind it, which is a pretty smart marketing campaign. It wouldn't surprise me if an agent kind of took this as the idea and ran with it as well. So I like the marketing campaign. Kudos to that. But the problem with Opendoor in the past, and this is the reason why they were sued successfully, is that the quotes they were giving weren't accurate. When the home value, it was the net to the seller. They would say, if you sell it for this, here's what you would make. And then they would go under contract with them. There'd be all these additional fees and they'd make far less. I think we calculated on the show a couple of years ago that they were taking about 10%, where the traditional agent was taking somewhere around 5 to 7. So it looked like they were saving money, but when it all shook out, they weren't. Now that lawsuit has gone through, Opendoor has been forced to change their practices. And so supposedly that's no longer going to happen. And they'll be giving more accurate numbers and data and giving people the true amounts. I don't know. It's an interesting marketing scheme. I don't know that it's going to work. Has Opendoor made money yet?
We're talking about delivering offers to people's houses.
Yeah, I mean,
right?
They're going to the house, they collect the information, and then they tell them how much their home is worth and give them an offer.
I mean, next thing, the MLS book will come back and we'll be advertising for that. I mean,
that's good.
I'll deliver an offer to somebody's house. Yeah. Am I missing something here?
Door dashing your home's value. That's a good comment by Matt LaMarche. He said, nah, I'm out. Man, think about that. If you don't tip those drivers, they're just going to throw that food at your door too. So be sure you tip your Opendoor driver. I mean, Matt, you just put that in such a different light with one phrase. That's such a great, yeah, not interested. Huh. Do you want to DoorDash your home's value? I don't think so. Hire a pro. That should be what a Nashville realtor does. I mean, that's good stuff. Really, where are you? Like, let's talk. I'll credit you, Matt, that you had that. Okay. So I don't know if that's going to save Opendoor.
Hey, Ray.
Yeah.
Ray.
Yeah.
Opendoor is still garbage. And here, I'll tell you why. I just did an appraisal on a property here in Atlanta where they bought the property from this person. They did absolutely, positively nothing to this house. They bought it, maybe 2 months ago. And they had it, I think they bought it for like $230 something, $240 something they bought it for. And now they're trying to sell it for $275 2 months later. And I have like 7 perfect comps right in that general area. I mean, it's literally like in my neighborhood. And I appraised this thing for pretty much about what they bought it for, maybe a little bit less, and they have a contract for it. Now I'm going to be the bad guy trying to explain why this house is not worth another like $40,000 more than what they bought it for. So I don't know what they're doing. I mean, it's ridiculous. I think Opendoor should just like shut their doors, plain and simple. And this mobile thing they have going on.
Yeah.
I mean, talk about a freaking lick. I mean, they can't even price things out properly to begin with. And now they're going to be going door to door. Hey, sell your home to us and we'll pay you cash for it for this and take advantage of all these people out there that don't understand that they can get a lot more for their house or they can actually do some different things with it. I mean, it's ridiculous to me.
Yeah. I didn't say any of that. That was Scap the appraiser, not a Realtor member. He can say whatever he wants. Maybe by driving over to people's houses and actually taking a look at it in person, they'll start to be more accurate with their data. Maybe this is the transition to them actually going to someone's house instead of just taking, the online inquiry, which Hillary Kerchief says, can't find the online inquiry to get them to my house. Would love to see their offer, quote unquote. Yeah, I'd love to see how it works. That's it. Maybe they've blacklisted real estate agents, Hillary. They just took the whole MLS data and said, if any one of those real estate agents goes to our site, don't show it to them. Probably not, but it would be cool. Meg said it's working for them so far. Megan Beekman, realtor on Instagram. They're actually not making money though. I don't think. I can't remember. We'll have to look when we're about to get is the second quarter? Yeah, second quarter's in June. So at the end of June, we'll have the second quarter numbers and we can see how they're doing. But I don't think they've been making a tremendous amount. I think they've been servicing a lot of debt. And Megan says she's not a big fan. Well, thanks for tuning in. I know you're a big fan of the show, so thanks for tuning into the show. All right, so let's go to RE/MAX. RE/MAX announces more changes in its C-suite offices as the COO resigns. Chief Operating Officer Serene Smith is leaving after 7 years at the role. Rob Fuchs has signed on as the new EVP. Changes follow the departure of former CEO Nick Bailey, who's a friend of the show, has been on the show before. He left in February. So this is just a note. We've been following kind of some of the C-suite shakeups all around the industry. So Smith, who's been with the franchisor as an executive role since 2010, will earn a severance. It includes continuation of her salary for a year and health benefits, continuation of her salary, a year of health benefits. So I don't how long does your salary go for that? That's cool. Accelerated vesting of shares in the public company, and her retention of a bonus if she remains in her role as a part-time project manager through November 13th. A replacement was not immediately named. All right, so another shakeup at RE/MAX. They've been trying to make a lot of changes over at RE/MAX. I don't know how it's going ever since Adam left. I liked Adam a lot. He was also a friend of the show and was on the show. So if you're a RE/MAX executive and you want to come on the show, we've had a long-standing tradition of great RE/MAX executives coming on the show. I'd love to have you on there. All right, so that's it for the industry tea. Not too much happening, just a couple of things with the lawsuit and then Opendoor and RE/MAX. So we have some big news coming out of our friends from the north. My brothers from a northern mother. Bank of Canada cuts rates 4.75%. Oh, I'm sorry. Wait. Whoa. Hold on. Bank of Canada cuts rates to 4.75% and signals more to come. So the Bank of Canada dropped rates a quarter point. Policymakers led by Governor Tiff Macklem lowered the benchmark overnight rate by 25 basis points to 4.75% on Wednesday, widely expected by markets and economists. So everyone was kind of predicting that it should happen and reasonable to expect further cuts. Changes in Canada. They just got their first 30-year mortgage. Olivier, are you using that much yet? Y'all haven't had 30-year mortgages. I know that's going through, but I don't know if you've actually had people apply for it.
It's not 30 years like you guys. It's a 30-year amortization, but the rate resets at whatever term you choose.
Interesting. It's 30-year amortization. The rate resets whenever so I can basically get a free refi? Like 10 years in, if the rates go down, I can say, hey, redo the rates, make it go down.
It's not a free refi. It means, for example, you get a 5-year term on your rate. Let's say 5% for 5 years. In 5 years, you'll renew for whatever period you want your rate, but you're not getting money out of the property. You could refi, but you're not getting money out when you just get it's like a rate reset, if you will.
Oh, interesting.
And you get to choose your term.
Okay, so you have to choose your term up front on the 30-year note. I can't say, hey, well, let's get a 30-year loan, and I'll let you know when to redo the rate. You can't do that. You have to say every 5 years, I want to redo the rate. Is that right?
Yeah, that's pretty much it. And most people, the traditional loan is 5 years. But if you sell before that rate reset period, let's say you sell after 2 years, you can get huge penalties because of the rate differences. We've seen penalties in the tens and $20,000 easily. The only well, go ahead.
No, I was saying that's a pretty steep penalty.
So that's why you have to choose your term wisely. If you expect to sell within a year, for example, you're better to get a variable rate mortgage where your penalty will be 3 months of interest only.
Interesting. Okay. Now, traditionally, you've only had 15-year mortgages, right, Olivier?
25 years was the standard amortization period. If you put more than 20% down now, you can go to 30 years. And even in the multiplex, in the apartment buildings, you can go up to 50 years. And even 55-year was announced, I think, yesterday. I don't know all the details because I don't sell out a lot of apartment buildings, but you're at 50 years. But it's getting pretty ridiculous. We're almost getting like Europe, where you have 100-year mortgages now.
Wow. So when the Fed there cuts rates, what does that mean for your marketplace? Does it increase the number of buyers who are making offers on properties? Do you see an increase in supply coming down the pipe, or do you still have a supply problem where you are?
So that the rate cut will essentially impact tomorrow variable rate mortgages. Will all probably go down within a day or two by 25 basis points. The fixed rates are correlated to the government bonds, and rates have been down. So I don't think it'll change a lot in the market short term, but people have been under a lot of pressure regarding interest rate, debt, inflation. So it can only add some relief, but I don't think 25 basis point will change the market. If we go down by another full point within a year, then maybe that will start to have an impact. But 25 basis point, I have a line of credit of $100,000 right now. My rate will go down by 0.25. It's $30 a month that I'll save in interest. Well, okay, it helps, but will that change my life? I don't think so. Would I buy a bigger house because I'll save $30 per 100,000? I don't think so, but it's good. I mean, I can buy an extra bottle of wine every month, basically. That's about it.
What are the historic rates in Canada? Because I know if you take the last 40 or 50 years in America, you're looking at something around 7-8%. What are the historic rates in Canada? Averaging.
We're pretty much at the historical average right now. Around a 5-year rate, you'll get around 5%. Might be just a bit lower, a bit higher, but around 5%. And that's pretty much the historical average over the last 20, 25 years. My first property I bought like 20 years ago, my mortgage was 5.85%. The only difference was I bought my property for $81,000, and that property is worth $300,000 today. That's the real difference, but we're at the same historical rate that we've been over the last 20, 25 years. We're about there right now. So I don't think we'll go much lower than the low 4s, high 3s. I don't think we'll go lower than that. We won't go back to, we had like 1.8, 1.9% mortgages at some point, which was crazy low, but I don't think we'll ever get back to that, or I would be very surprised we get back to that.
Very interesting. Justin Conoco, he's over on Instagram. He's chiming in. Race just went down in Canada, bro. I know, man.
I'm on Clubhouse too, bro.
Oh, you're on Clubhouse now. All right, sorry. You're in. Hey, man, how are you?
I'm good. I came over here. I'm super happy to see all these faces here, but nice to see you, Mr. Ray.
I know. You like all this Canadian news coverage that we got, courtesy of Olivier in the. He's in our contributor chat. He sent this to me this week.
Anytime I hear him speak, I'm happy.
You just like the French Canadian there. Olivier, by the way, I'm still like 400 and something days into French. So, je vous parle français. I want to.
You're getting
French.
Articles in French soon.
Okay, good. I can tell like some of what things say, but it's not great. Justin, what is your take on the rate cut? What is this going to help? Is it going to hurt? Is it a big deal? Is it not a big deal? Is it the right plan, or is this dumb because it's helping buyers and you need more supply?
Yeah, it's definitely the right plan. They've been kicking the can down the road too far, raising interest rates and printing money like it's going out of style. So doing both things at both ends of the spectrums. And I think we actually incorporate housing inflation into our CPI data, which not many places in the world do that. So of course, inflation is going to stay high when you keep cranking rates, and it's just destroying the marketplace. Now, I agree with Olivier. I don't think it's going to make an instant change in terms of buying power, but here's an example where I do think it makes a difference. Is if you have 100 people looking to get out into the marketplace, probably only 20 or 30% are actually out there right now. So I think that this drop will bring back another 20 or 30%. And then if they drop rates again in the fall, it's going to bring back another 10 to 20%. And I think that it's going to be a slog, but I think it's a great indicator of where things are going. And the other thing that I think it does for Canada is it'll encourage people that we've been kicking the can down the road long enough, and now we're heading towards let's get back to work, right? And I think you're going to see a turnaround from that perspective for sure.
Interesting. Well, cool. Well, thank you for the northern takes. As I like to say, my brothers from my northern mothers. And by the way, your maple syrup, incredible. I'm not saying that jokingly. It is very different than the American maple syrup. I brought some home to the family and kids, and we did taste testing samples. It's different. So I liked it. I love your country. I was in Banff a couple of weeks ago. I know I talked about that. Was that last week that I talked about it too? Gorgeous place. Oh my goodness. It's so pretty. And the Fairmont there is like a castle. So it was a very cool experience. So highly, highly recommend Canada, except you guys drive so slow. Oh man, it was slow. And everyone was obeying the speed limit. It was wild. Here it's like, I felt like when I came back and then drove in Little Rock, I felt like I was joining the Autobahn is that what it's called? Where you just like open it up and drive as fast as you can. Anyway, but I had a good time. I see that Justin's got the Mounties in his Mountie avatar there. All right, so let's talk about mortgage applications. Mortgage demand falls for the second straight week, but all eyes are on Friday's jobs report. Interesting that this dropped today, and the Fed is releasing notes today, but it said all eyes are on Friday's jobs report. Mortgage interest rates last week moved to the highest level since early May, and that pushed mortgage demand lower for the second straight week. Total mortgage application volume fell 5.2% last week compared with the previous week. The average contract interest rate for a 30-year fixed mortgage conforming loan balance of $766,550 increased to 7.07 from 7.05. With points rising from 0.65 to 0.65 from 0.63. It always kind of confuses my words when they put the high number first. Sorry. All right. So Mike Frantantoni, Senior Vice President and Chief Economist at the Mortgage Bankers Association, said mortgage rates moved slightly higher last week, with 30-year conforming rates reaching 7.07%, its highest level since early May, despite incoming data indicating somewhat slower economic growth. Which, all right, this is kind of weird, but slow growth is good for lower rates. Expansive growth means there's more orders for stuff. And when there's more orders for stuff, inflation increases because the producers can't produce all the stuff that they have orders for, so they have to raise the price. So they raise the price on the stuff, and that is inflation. The Fed's goal is to maintain full employment while keeping inflation low. And so if inflation is up, then they're going to keep the rates up for longer or even increase rates. So a economy that is starting to slow is actually a good sign if you want lower interest rates. Mortgage applications to purchase a home dropped 4% for the week and were 16% lower than the same week a year ago. Buyers are not contending with high interest rates. Home prices are still rising, and competition, especially the lower end, is fierce. So that's where we're at. Mortgage applications decrease mainly due to rates, but also due to the buyers' just lack of affordability. And we can see this in the sky high prices. We talked about this a little bit last week. There's another article about it today, but it's different. Price drops. They hit the highest level in 18 months as high rates dampen buyer demand. So this is interesting. We have had a huge increase in price drops. However, the overall price of homes sold is still higher than it was last year. So nationwide, 6.4% of home sellers cut their asking price during the 4 weeks ending May 26th. The median asking price dropped roughly $3,000 to $416,623 last week. That's the first decline in 6 months. Additionally, for sale supply is growing more stale. Average inventory, the number of days active listings have been on the market, started rising for the first time in 8 months, hitting a median of 46 days. All right, so chime in the comments, drop in the comments. What is the average days on market and median days on market, or median days on market? You don't have to do both. But what is your average days on market in your marketplace? I find that if I do the average, it's always longer. But if I do the median, it seems to be more accurate with what we experience on a listing by listing basis. So what is the median days on market for you guys? Drop it in the comments wherever you're watching. And also tell me where you're located. So buyers did get a modicum of relief in housing costs this week. Typical U.S. homebuyers' monthly housing payment dropped $2,812 to its lowest level in 6 weeks. Payments are declining because even though sale prices remain all-time highs, mortgage rates have come down since their peak. Well, that was until this week, I guess. So this article is from May 30th, 6 days ago. So last week they got a little bit of a reprieve on that average payment, but this week it went right back up. So, Olivier said this either means you sell quick or you're in it for the long run. That's exactly what we're trying to communicate more to our clients. Hillary says 48 median Nashville, 48 days. Olivier said the difference between the median and average is crazy. I remember seeing 30 days median versus 60 days average. Yes. There's just some of those properties that have been on the market for 3,000 days. And that really messes with your averages. All right, so median in Nashville is 48. But we're trying to do our best to communicate to the sellers. We have several, actually, in which we're telling them pricing information, and other agents are coming in behind us and telling them much higher prices. And we're trying to do our best not to blow smoke. And, there have been 2 listings recently that have chosen to list with someone else because that agent promised a higher price point. And those homes are still listed. And one of them is now $10,000 away from where I told them it would sell. And I'm afraid that they're going to have to chase the market down even further because now they're a stigmatized property that's been on the market over 120 days. So you could really, the market is super price sensitive right now. And if you're not pricing it correctly, then I think it could be very detrimental to your seller. So you guys be careful. All right, so this report comes from Mike Dupreet. Skyrocketing delistings and the pricing imbalance. So how are you guys seeing a whole bunch of properties come off the market? Withdrawn, expired, etc. Are you seeing properties come off the market? This is really interesting because it's non-seasonal. So we're breaking out of when delistings normally go up towards October, November, December. We're breaking out of that trend, and we see a rapid increase in the number of delistings in May. If you look at the national delistings as a percent of total listings, they're roughly double the normal rate, bucking the seasonal trend and accelerating rapidly. So this is also interesting. Here's the new listing median price per foot. It's up over $220. It's the highest level since ever. 2023 was around 210. 2022 was around 210 at this time of year. And then 2021, it was at about 180. So right now it's over 220. So this is wild. The new listing median price per foot. So this means that people are putting their home on the market at still these aspirational prices that we're trying to communicate with our clients do not do. And then they're not selling at that price and they're coming off the market. So the question is why? The other thing you could look at is the percent of active listings with price drops. What is this in your area? So this is a lot higher than 6% in my area. Let me actually bring that up. So we talked about this on a mastermind yesterday, the Tactics and Trends Mastermind with Tim and Ray, yours truly. And I brought up the report that I'm about to share with you that shows in Little Rock what the properties with price decreases. So this is a really interesting chart. For the audio listeners, the properties with price decreases right now is around 40%. If I go 1 year away, and this is in Little Rock, if I go 1 year away from that, the active properties was around 30%. If I go 1 year away from that, so this is 2 years ago, it was around 20%. And then a year before that, it was around 22%. So it sounds terrible. If you just look at that half of the chart from the start of the COVIDs to today, you're going to say, wow, the number of homes that have decreased in price that are active on the market has doubled. And you would be right. But there's a couple of things to note about this chart. If you go all the way back to June of 2019, before any COVIDs, the 7-day average and 90-day average was right around 40. 40% of properties on the market were dropping in price. So the other thing we note is that it seems like May, June is the low, and there's a seasonal hump where you have more price decreases through November, December area. Every year, we see this seasonal hump. And so what that tells us, we are now at a recent unseasonal high of the last 3 years. This is an unseasonal high. But what this tells us is that this will probably go up. So the number of properties with price decreases will probably continue to rise in our marketplace. So this is really helpful information for you guys to communicate to your sellers so that they don't get in a really tough spot of listing too high and then being some of these properties that should have sold, but they didn't sell. So now they're a stigmatized property because they've been on the market a long time. And I'm using Altos, ALTOS.RE for this data. It's pulling active data. This is not sold data. All right, let's go back to Mike Delpreet. So he sees the percent of active listings with price drops nationally is somewhere around 6.5%, which is still high. And for houses that are selling, it's taking longer. So the median days on market is right around, 35%? So it's quicker than it was, what's this, towards the beginning of the month? He forgot his, is this the x-axis or y-axis here? But it seems to be quicker than it was earlier this year. But it's still, you have this little bump that you don't normally see during this time period every year. So he says the bottom line, the surge of new listings coming to market are overpriced, leading to rapidly increasing number of delistings and price drops. This is the start of a price correction. The sellers are bringing more inventory to the market, but with aspirational pricing, the buyers are not willing to pay. The record number of pricing corrective measures will likely lead to an overall correction, lower prices as supply and demand continues to rebalance. So the question I have is, will this imbalance be corrected in the form of home valuation, like home sales corrections, or are we just seeing a correction from the aspirational sales price to a price that the home will actually sell? That's my question. Once we see that the sales of this home were lower than the sales of this home last year, that I think is when you have a correction. A correction is considered a 10% change. So that's, I think, when you really see the start of the correction. Matt Lamar says 41 days on market in Atlanta. Let me check our days. What is my median days on market? My median days on market right now is 42. The average is 79. 79 7-day average, or 86 is the 90-day average. So yeah, that's crazy difference in average. And I like the median because it seems to be more realistic with what's happening in my market. All right, so drop in the comments, what's your average days on market where you are? We'll take a look at it next week. But skyrocketing, delisting, and pricing imbalance. Are you seeing more people pull their home off the market, guys, in Clubhouse? Is that, y'all can clap or unmute and mute. Julie, I see you unmuted. What's up? Did you do it on purpose?
It was an accident. No, I'm sorry.
How are you, Julie? Good to hear you. That's funny. All right. So the other thing that happens when people can't afford stuff is that renters start to stay put. So we have yep, here it is. Our renters are staying put longer, with 1 in 6 now living in the same home for 10 years or more. So 10 years plus, 1 in 6, 16.6 renters stayed in their home for 10 years or more in 2022. 5 to 9 years, 1 in 6, 16.4% lived in their home for 5 to 9 years. 1 to 4 years, the lion's share of renters put 1 to 4 years, 41.8%. In 12 months or less, only 1/4, so 25%. So, and I like that Redfin does these graphs where they have every year a slightly different color, so you can really see exactly how this stacks up. And one of the things to note is that this is just not, it's just not a gigantic difference. Now, there are 2 years included in this number. We don't have 2023 yet. We don't have anything for 2024. But what they're comparing is 2012, that's the dark green, 2019, 2021, and 2022. There's really not much of a difference in 21 and 22 in any of these numbers. The majority of the difference is that in 2012, 32% of people said that they would stay in a home 12 months or less. And now that number is 25%. So it's 7% different. That's the biggest change on the graph. So, I mean, it is more people are likely to continue to rent versus a decade ago, but I just don't see that graph as anything troubling. It's just, especially if you're looking at the COVID years, I mean, you have a lot of people that are staying put because they don't know where to go or afraid to go somewhere. So let me see what 2024 and 2025 are like. Then I think you can get a good read on this. Oh, did Trudeau get in club? Did you send Trudeau our clubhouse?
Sure did.
That would be rad though, actually. What's up, Hillary? I see you on Clubhouse too. All right, so I'm going to quickly breeze through a couple more articles, and then we're going to get to the word on the street with the Fed. Investor home purchases. So those actually jumped. Last week, we talked about our investors being a little disinterested lately, and that's still what we're kind of seeing locally. However, this report says investor home purchases jumped for the first time in 2 years. Here's what it means for buyers. Consumers confronted with high housing prices sometimes point to private equity when buying homes as a contributing factor. However, experts say while housing market has multiple issues, it's hard to determine if real estate investor activity is truly deterring people from buying a home across the U.S. Real estate investors purchased about 44,000 homes in the U.S. in the first quarter. That's 0.5%. That's up 0.5% versus a year ago. It's the fastest increase in this since the second quarter of 2022. So, and then they go to like what that means for home buyers, engaging an investor's effect. It's really not too much of a change, actually. And most of the investors are not institutional investors. They're people that own, 2 to 3 to 4 homes. So that's the rave phrase of that article. All right, we spent $1. I just wanted to show you guys this because this is one of the things that we were talking about. As situations change around the country with purchase prices, and we've been talking about the multifamily and everything that's happening there, I think you're going to have some unique opportunities to take special real estate and convert it into multifamily units. So we spent $1 million on this abandoned baseball stadium and $14 million to convert it into luxury apartments. Take a look inside. So this is this is pretty rad. Here's some photos from it. So basically these investors converted this old baseball stadium into a luxury apartment complex, and they still kept the baseball field. So I'm guessing you can go out there and play baseball. I mean, it's got, cages and still got the infield and all that stuff. But they made balconies of chain link fencing to create a stadium type appeal. I guess chain link fence for, maybe they could have put like a Wrigley Field, some homage to baseball stadiums and stuff would have been cool. I don't know. It looks okay. I guess the inside probably looks a lot better. Uh-oh. How did that happen? Sorry. It bypassed. So that's a second call from somebody because it bypassed my do not disturb. Sorry. All right. So I thought that was a really cool article. You guys can find that on CNBC. This would be a good one to talk, to ask your followers, would they live? That room looks really small. Would they live in a baseball stadium? There's you a green screen idea. All right. And then the single family and multifamily production head in opposite directions, depending on what part of the country. So this article is from the NAHB, who are our builders. While single family construction expanded in the first quarter, despite higher mortgage rates, multifamily construction for 2024 is experiencing a notable slowdown, primarily because of financing conditions are tight. And there's more than 90,000 apartments under construction, near the highest rate since 1973. So this is the first time since the inception of the HBGI that tracked all the multifamily demographic areas registered negative permit growth rates. So there's fewer permits for multifamily, and that is in part because of all the multifamily that is still under construction. The strength in the single-family construction at the start of the year was particularly concentrated in the higher density areas as a return to office trend lifted demand in inner suburbs. That's Chief Economist Robert Dietz for NAHB. This corresponds with other data indicating the gain in townhouse construction at the start of 2024. In contrast, the apartment construction slowdown is disproportionately affecting higher density markets where high levels of construction inventory, elevated cost, and tight financing is impending multifamily supply. And then they break down the numbers for you guys. You can go see that at nahb.org. Just click on the news section and you can see all that stuff. All right, one more article. I'm curious. How many people are doing this or had this idea? Luxury homebuyers can now get an art collection as part of the deal. So there's a couple of realtors. They may both be with the agency, Paul Lester, and there's one more in this article too. I'm sorry, I can't remember the name off the top of my head. But basically, they are putting art in homes as part of the staging, and many times selling the artwork as part of the home. Now, which is a great idea. That's really fun. And I would love to see more people like use local artists for staging and then have those pieces for sale. I think that's a really fun and cool idea. But they're doing it on a grand scale with luxury properties. For instance, the homes known as the houses at 8899 Beverly started around $5 million, and rather simply being staging pieces, they brought in temporary art and furniture, so it's available for purchase. Now, in some of these homes, he said, one of the guys was like, well, like you have a $20 million or $50 million house, but the artwork inside the house is $200 million. Yep. The artwork inside the house is $200 million that's on display, but the house itself is here it is. The house might be worth, let's say, $60 million or $70 million, but the artwork in the house is probably worth $200 million. Wow. So it gives the buyer an opportunity to also purchase artwork as part of the deal. So have any of you done this? Go ahead, Sherry. Oh wait, no, that's Jen. What's up, Jen?
Hey there. So I used to be, I was an art historian. That is my major, art history.
Wow.
So that is why I'm such an amazing realtor. But I have looked into this before because, we're in Portland.
Yep.
The problem is you have to get insurance, and the artists need insurance on their work if something happens. So I do it a lot actually for friends of mine who are just want to get exposure. And then I take professional photographs and I tag them as we're staging. So I use them as part of the staging. And then they get exposure and things like that. So it works out, but they also have to risk the artwork being stolen.
Oh, so, wow.
Yeah.
I've not thought of that. That is really interesting. I guess somebody could just well, and if you have the security and stuff, you'd know who took it at least. They were registered with the real estate agent. But that is true. If you put all these photos and everything all around the internets, then people know that artwork is in the house. And if they are an art thief, which that's big business, by the way, it's not just in the movies. If they are an art thief and they see the opportunity, that is a less secure environment than a museum, isn't it?
Well, and even just because I've had whole houses of staging stolen. And
What?
I mean, once I went to an open house on a Sunday morning and opened the door and I was like, oh, this is weird. And I called my client, said, do you stage at the house? They took everything, toilet paper,
Oh, no.
every single thing. This was a long time ago, so I can laugh now. But the stager had to put it on her insurance. And had it been like a friend of mine who was an artist who had all their work in there, I would feel horrible. So I do it occasionally, and sometimes I'll do it for staging and for photos for the exposure, and then we'll trade out the artwork.
Interesting. That's a great idea. I mean, I love the idea, and I love the, like, you know, giving local artists additional exposure. I love collaborating with them on the creative. It's such a fun idea, but I didn't think about the dangers of it until you chimed in. So I'm glad you're here, Jen. That's really smart. So you'd have to get insurance on it, and they would also have to have insurance on their piece, correct?
Well, it depends. You know, it depends on how important of an artist. Not important in that way, but you know, if that's their complete livelihood and they lost all their inventory, that would be a problem. But I have one of my girlfriends is an artist, and when I have a new, like a rehab project, I'll say these are the colors we're going with, and she'll come up with something, and oftentimes she'll just like make us something, or she'll go through her stock and kind of find stuff that works. And then she's got professional photos, which is really nice. And then she shares them on hers. So it's just, you know, keeping it in the family, which I love.
That's, yeah, very interesting. Well, thanks for the tidbit, Jen. That's a really great point on all of that. All right, let me look and see. I'm not seeing it. Did I get the date wrong? Hang on just a second. Hang on. Oh, it looks like it may be on the 12th. We're professionals here. Is it really the 12th? Apparently I was looking at next week's calendar when I was planning the show this week. Because it looks like he's, let's see. My bad. The Federal Reserve meets next week and will once again decide the interest rate. Oh, so I started the show for 5 minutes late for no reason. But the real reason was because like people like Mr. Social Savvy could go join on Instagram because we're running late today because I thought the Fed rate was there. Man. All right. Well, I need some sleep. I need to stop traveling. I need to get some sleep. So it looks like the Fed will announce next week. My bad, guys. Well, thanks everybody.
Ray,
yes. Yeah. Go ahead.
You don't make mistakes like that. You must be off your game.
I mean, it's maybe I was just teasing everyone so they would all stay. And then at the end you find out, oh, it's next week. So you have to join the show next week. I do want to say for those of you who are still here, we do have a book club, and tomorrow we're starting the Happiness Advantage. And I'm really looking forward to that one. The premise is a lot of people say, if I could just do this, if I could just do that, then I'd be happy. If I could just cover the Fed rate today, I would have been happy. Well, instead, the book premise is be happy, and then everything else will start to happen. So I'm looking forward to it. I think it's going to be a really good discussion. If you're interested in that, go to my Instagram. It's Razorback. That's RAYZORBACK. And just DM me the word book club. Words. It's 2 words. You could actually send 1 or 2 words and it will work, I think. But DM me the word book club and you'll get all the details. You'll be able to sign up. There's a little Google form there that'll take everything that you text me and put it there for you. And you'll sign up for the book club and I'll send you a link to the call. And tomorrow's the intro for the Happiness Advantage. So I'd love for you guys to join me there. And if you like the show, please share the show. One of the reasons why we do this is to have wonderful discussion with people all around the country and get incredible input, just like Jen said. And then actually the countries, I should say countries, because we also had Justin and Olivier here from Canada who told us what the rate drop, the impact that had in Canada and all that stuff. So thank you guys for joining the show. I appreciate your participation. And for those of you who waited for the rate cut, I appreciate your patience. We'll get it next week. Bye, everybody.